Hi, I'm Andrew with Investors Hub, and today we're talking with ADVFN CEO Clem Chambers about some of the market forces that are going on in late December here, early January area. And we're also going to get an update on what's going on in the crypto world and where he thinks it's going to go. If you like the content, be sure to like, comment, and subscribe. You can also follow us on Twitter at ihub_vision. And let's hear from Clem. What market forces are in effect in this late December, early January period, and what stocks in the market do you think are the most affected by it?
Well, I think what affects the market most right now is that everybody's asleep and the professionals aren't around. So there's a kind of hiatus around Christmas time. Now, that's much more of a thing in Europe, but even in the US, your volumes can be down, market can be a lot more fragile, and people are, a little less jumpy than they would otherwise be. But then the new year comes along. And it used to be said that if the market went up the first 2 or 3 days of the year, you're going to get a good year. There was a sort of prediction, a correlation that the first 2 or 3 days would be a strong indicator of what the institutions would be doing and what the funds would be doing. Because the funds would tend to do some housekeeping in December because they want to say, hey, to the end of the year, we made 47% or whatever percent they made. And they'll do quite a lot of jiggery pokery to be able to say numbers that are nice. So they'll also do things like before Christmas, they'll go out and they'll buy the shares that they already own. They'll buy more of them to push the share price up of their portfolio. So they can say at the year end, they got an extra 4%. But actually, they falsely created that 4% rise by going and buying the stocks that they already own in the market in volume just before the end of the year. And that's where you get Santa rally, and it's called window dressing, which is not necessarily a good thing. So you get a lot of strange occurrences in December. But in January, they reset. So if they bought a load of stuff just before their year-end accounting, and they didn't really want it, they'll dump it at the beginning of January and push the prices down. But if they do want it, and maybe they want more, because maybe they had some inflows, then they will buy more at the beginning of the month because they've been, eating Christmas pie and not paying much attention. So they've got a backlog of work to do. So it will show the balance of the market in the first 2 or 3 days of January. So it'll be an indicator of what's to come. So that's been a long-term indicator to look for. So that's something to look for. Now, the big driver on the market remains the Federal Reserve. And the Federal Reserve, if you look at their balance sheet, which you can find on their website, they kindly show you exactly what they're up to. It's notching up. And if you put the Dow, the S&P up against that chart, you'll see they go together. Because they pump money in, and that money doesn't, in this new day and age when people get written checks for breathing in and out and suddenly get a stimulus check, hey, let me stimulate you with $600. I thought that was actually against the law, but obviously the Fed don't think so. And they are stimulating everybody. Oh, the government is, but in the end, the Fed buys the government debt to enable that money to exist in the first place, which is, again, not a very good thing coming up. But the Fed's pumping money into the financial system means that money goes directly into the stock market and directly into equity prices. So if they pull some out for technical reasons, the market goes down. When they pump it in, it goes up. And they're doing this pumping the market up thing. Because their idea is if you pump it into shares, well, everybody gets a bit richer, everybody's pensions are a bit richer, et cetera, et cetera. And then they sell their shares and then they buy McDonald's and people make McDonald's make money. So it's the trickle down. And trickle down is good because it's not inflationary. But these days, governments are getting into this idea of just shoveling the money in at the bottom of the pyramid, which is, I can understand that. It's probably a relief to a lot of people who are strapped for cash. But of course, those people not only want to spend money, they need to spend money. So unlike the rich who you give them $10,000, they go, oh, that's very kind. In the bank it goes. The bank takes it and goes, oh, don't really want to lend it to any poor people. Let's put it in the stock market. Up goes stocks. Someone says, oh, my stock went up. I sold it and I bought a car. And then it starts to trickle down. Whereas if you just give it to a load of people that maybe need groceries, bang, they buy groceries. And that's quite an inflationary dynamic. When you have the non-rich people, they don't like to be called poor, sadly. The non-rich people get given money, they spend it immediately, and that drives prices. And that's one of the reasons why this year will see prices start to move because the non-rich are being stimulated directly, and that is when you get inflation, and that is coming. But stock prices are almost 100% supported now by the Fed, or you could say by other central banks are also pumping money in, because the only way they can keep the system going is to pump money into themselves, because a lot of this new money is going straight to the government to hand out in its budgets, and to try to get it into the system without disrupting the system too much. And they do that by basically, with a small offset, injecting it into house prices and equity prices. So they're the two things that they inflate. They blow up, and then people die, and the houses get sold, the children get the money. They move house, they pay property taxes, that they pay capital gain taxes, so that's good for the government too. So they're the assets, and also bonds. They inflate bonds too. It's all part of that milieu of reflationary stimulus that the Fed generates. So interest rates go down, bond values go up, equity values go up, your house goes up. So if you hold bonds and if you hold equities, you hold a house, you're pretty happy. And then, if you're old, you'll lie and leave it to your children who spend it, and their taxman will get it. And, if you're not so old, you're still more likely to spend, but you're not going to be spending in a hurry. So that's not going to create demand pressure. And that's how the market gets maintained against these setbacks. Unfortunately, of course, what it also does is it gaps the differential between the rich and the poor, the so-called K-shaped recovery. Because if you've got equities, houses, bonds, money's raining down on you. And if you haven't, you're scuppered, aren't you? So that's why the poor are getting poorer and the rich are getting richer, and that wealth disparity is opening up. And actually, and everyone complains about that, or certainly it's a political beef. But unfortunately, if you try to close that, you generate inflation. So if you open the gap up, you keep inflation down. If you close the gap down, you drive inflation, which of course can be extremely damaging for economics. So that's a bit of a problem that really no one's talking about. But here we are, new year coming up, and the Fed's going to carry on printing, and the Bank of Japan is going to carry on printing, and Europe's going to carry on printing, and most countries in the world are continuing to dig the hole that is the economic disaster that COVID response is creating. And you can all cross your fingers that Biden won't lock everybody up in America like they've done everywhere else, because if that happens, that's good night. And with a bit of luck, the vaccine will work, and they'll start, getting on top of things the middle of next year, and they'll start opening up end of next year, and they'll start making a recovery at the beginning to the middle to the end of the year after next. But there's a fairly long and winding and bumpy road ahead. And with a bit of luck, equities will carry on being pushed up by the Fed artificially, and all our viewers who've got homes, which will be almost all of them, those values will go up, and the repairs will be made over the next 5 or 6 years in the same way as they were made from the credit crisis in 2008.
So, Clem, give us your crypto update, and let's talk about what you think is going to happen next.
I'd like to say that when we first spoke about this, Bitcoin was about $18,000, and now it's 28. So, if anybody did take any notice of what I was saying, they're about 50% up right now, which is not bad for a few weeks' work. So this is what's going to happen next. At the current level, I must say I am a little bit uncomfortable because I did buy at about 7,000. And as you can imagine, if you bought a reasonable amount of something at 7 and it's now 28, you're going to be a bit nervous. You've got to think about selling. Well, I think it's going to go at least to 35 to 40. That is what I'm thinking. And there's going to be a final run when it's going to go vertical. And I think I mentioned that in the previous broadcast. And that's what I'm waiting for. It's not done that vertical yet. It might not, but I think it will. And it could go as much as 50,000. So I'm going to be waiting for the vertical. I'm going to be holding on for the vertical. Now, that is, quite a few more percent. But the one that's really going to rip is going to be Ethereum. And Ethereum is going to go, in my book, according to my model, $1,800. And it's like $700 today. Now, when I look at Ethereum, I go, that could go to 2,000. And I look at Bitcoin, I can see that it's probably on its way towards 50,000. That's just the shape of the chart that you get with these kind of let's call it what it is, bubbles. But bubbles can go incredibly high. And sometimes bubbles aren't bubbles. I mean, Apple went through a series of these verticals over the years. But this vertical has got something to run. And I'm thinking, I'm going to be really, really biting my arm in the top 30s. And I might be able to hold on to the top 40s, but I'm gone at the top 40s. I don't care if it's going to 80,000. I simply will have a completely messed up portfolio. And you can't afford not to be diversified. So you've got to start thinking about diversifying yourself when things get too high. And people don't. They didn't do that with Apple, and they just held on, and it's worked out incredibly well for them. But you really are putting yourself in the hands of the angels when you do that. And it's a nice idea, but it's not for me. So I will be gone, 45 to 50,000. I will be getting out in any event. But Ethereum has got a decent way to go. So I am actually now, because I kind of want to buy everything in crypto at the moment, rather than buying everything, I'm kind of tending towards Ethereum. And I wouldn't say heavily loading up, because I was heavily loading up at $200 and now it's $750. So it's quite hard for a hard and bitter old veteran to start buying more at triple what he paid for his original amount. But nonetheless, I am very positive on Ethereum. I'm quite positive on Bitcoin. I think I wouldn't be holding it at this level in that depth if I wasn't very, very positive on it indeed. And I'm expecting it to go into the mid-30s very shortly, actually. And I think it will go into the mid-40s very, very quickly thereafter. However, if it does it slowly, that's great. If it takes its time and it's a hard old push to get up every $3,000 or $4,000, that will give me confidence of how far it's going to go. But if it just suddenly goes bang, then I'm gone. And Bitcoin could do that tomorrow, or it could, hopefully take a lot longer. It will just grind up, and if it grinds up, the top of this market is much higher than if it suddenly goes vertical. But I just feel it's going to go vertical sometime in the next week or two, and it will keep going vertical till it gets in that sort of 45,000, 50,000 range, and by which time Ethereum will be $1,400, $1,500, and will probably run on after Bitcoin has hit its high, like it did last time. Ethereum actually went, a few weeks on after Bitcoin hit its top and came falling off, and I think that's probably going to repeat itself. And then, after a breather, I think you're going to see the DeFi tokens go dramatically north. And that's what I will be kind of pivoting out of the Bitcoin towards Ethereum into more DeFi, and then quite a lot of Ethereum, but not as much as I would have before Bitcoin had maxed. I'll be gone to quite a lot of cash there, sadly. And then I'll be pushing some of that into the DeFi end. And that's going to be a bull market that's going to run on for 2 or 3 years. So really, it's just a matter of getting out of the top of each of these waves and getting in at the bottom of the next one. And that's what I think people should look to do.
Thanks for watching. Be sure to like, comment, and subscribe, and I'll see you again soon.